good morning. I have come with another module, and the importance of this is that we have completed salary computation. Now, what we are going to do is we are going to learn about income from house property, the computation of income from house property. So, this calculation also I have divided into different modules. The first module, I will explain all the theoretical concepts. Now, next module onwards, I am going to do the problems. See just how we have learned salary computation, small modules for each computation. And one thing you have to remember, this is not a lengthy chapter and there is only one standard computation. So this will make the process very simple. Don't compare this with salary computation where each calculation is different. Here you have to learn the standard computation for let out house property and self-occupied house property. Then your calculation is very simple. So this is the idea of this module. What I am going to do, I am going to do all the theoretical explanations. So when you will learn these theoretical explanations, now you will not be an expert to handle those topics. But when you will do the problems, I can narrate that, I can equate that with the theory what I have explained in this module. See, when I am doing a different module for problems, I cannot jump to theory in between. So that is why I have included all the possible theories for this chapter in one module. Then the remaining modules will be only the problems. So that is why I am telling you this module is very simple. You don't have to worry about this. Only the salary is little bit difficult, I can say that. All other chapters are very simple. So that is how I can say that income tax is a simple subject. First, when you will approach, when you will see that, when you will hear from others, those who have not got a standard education or standard teaching for the subject or a simple structured teaching for the subject, they will threaten you. It's very difficult. You will find it very difficult and all, but it's not like that. I hope that now you have learned that when you learn salary chapter, you realize that how simple this syllabus and the subject is. So this we are going to explain in a systematic manner and you're going to learn from this. So first thing I want to tell you is that section 22, that is basis of charge. So if an income has to be treated under the head income from house property, there are three conditions to be fulfilled. See, one or two problems I remember when we worked out salary chapter, I told you this income will go to income from house property, rental income received by a person. So this we will not include in salary chapter. This will go to income from house property. So how you find out an income will go to house property? So there are three conditions. First condition is the property should consist of any building or land adjacent to that. Usually a standalone building is not possible. Any building if you see, even if it's a house, some place will be there surrounding that. Maybe a kitchen area, maybe a garden space, anything like that. If you live in an apartment, if it's a big complex, you can see that walkway will be there, parking space will be there, lot of surrounding areas will be there. But even if it's an independent house, property will be there, a building will be there, plus some adjacent land will be there. Second condition is assessee should be the owner. Ownership is very important. If you are the owner, you have to pay tax if you are getting an income from the house property. Or even if it's self-occupied house property, there is an advantage. I'll tell you that. Now, third condition is if property is used by the owner for the purpose of any business or profession, then it will not come here. See, a businessman or a person doing the professional business, he is using his property for his business or profession. So this, he himself is carrying on that business. So these three conditions are there. First is building is there and adjacent land is there. Second one is assessee should be the owner. Third point is that building is not owned by the assessee either to carry out his business or to his profession, and he is only doing that business. That meaning he himself is doing that. He himself is doing that business or he himself is doing that profession. Then it will be a totally different treatment. So here this not used by. So this is the third condition you have to remember. Property is not used by the owner to carry on his business or his profession. So these are the three conditions. This you can expect for 2-mark question. Now the next point is who is a deemed owner. This I have seen that in 2 marks question. Who is a deemed owner? Deemed owner you have to remember. Here it is. Section is mentioned. Section 27. Please remember the previous section also, I have mentioned the section. Wherever I have mentioned the section is important. When you write the 2-mark questions, you have to quote the section also to score the full marks. So deemed owner meaning 5 points are there. See, certain cases, see sometimes when people, if they want to escape tax, they will use some tactics to avoid tax. So these are the explanations I am giving. See, a person transferred the house property to spouse or minor child without adequate consideration and without any agreement to live separately. See, usually in a divorce agreement, usually the property, if they are separating as husband and wife, and children are going with either with the father or mother, there will be some division for the family property or what all assets they will have. So if the property is transferred to the spouse and minor child with an agreement to live separately, then that person will get the ownership. Whereas if they are living together and just for namesake, just to avoid tax payment, if the husband is showing that property is transferred to wife or to minor child, because minor child will not come in the tax liability. So this, if the spouse is not working, she will not come in the tax liability. So to avoid tax payment, if he is just doing is an arrangement, the income tax department will consider the person who transferred the asset as the owner. So he will be the owner. This is just an internal arrangement between the family members. But if they are living separately, if it's a divorce settlement, they are living separately, property is transferred, meaning then the income tax department will agree that, because now the ownership will transfer to the spouse or the minor child as per the divorce agreement. Second point is holder of impartible estate. So the meaning is ancestral house given to eldest or youngest son. See, in India we know that we follow different religion. Christians are following that usually if it's a male member is there in the as a child. See, 3 brothers and 3 sisters and 1 brother. That meaning usually the ancestral property will go to the son as per the Christian tradition. Maybe if it's Hindu tradition, the daughters will inherit that. So different religion, they are following different rules. So that meaning the property is not divided. So the ancestral property is given to the eldest or youngest son. That meaning it can be eldest daughter or youngest daughter also. So then they will be considered as the deemed owner. They will be considered as the owner for the income tax purpose. Next is property held by a member of cooperative society, company or association of persons. See, I live in an apartment. See, here we have 8 flats. So everyone will get the ground portion, the building that where it's constructed, that 1/8 share will be owned by our family. So that is how every member, everyone, whoever the owners 1/8 share will be there. The ground property, that is whatever 1/8 share. The entire building 1/8 the land will be our ownership. So that is the member of a building society. If they have 100 apartments in that building, then it will be 1/100 share each member will get. So that is the arrangement for the member of a building society. So they will also get the ownership in that building. Now, a person who has acquired property under power of attorney transaction. I told you, a person living abroad, if they have family, if they have a property here in India, what they will do, they have to make the tax payments at the time when it is due. They have to make the payments. So what they will do, they will give the power of attorney to a person whom they will trust. It can be parents, it can be family members, it can be friends, it can be relatives, it can be a lawyer, anybody. So whoever getting that ownership, for the time being they will be the owner. So they will be considered as deemed owner for tax purpose, because they have to make all the payments on behalf of the owner, actual owner living in a foreign country. See, I gave you the example last salary chapter also. My sister living abroad in UK. So she has property in Kerala. So she has given, when my father was alive, she has given the responsibility to my father through a power of attorney. Now my father is not there. Now my brother is getting the responsibility. Now my brother is getting the power of attorney, and he is making the payments on behalf of her. So actual owner is my sister, but brother for time being he is considered as the deemed owner, because we want an owner to make the payments, tax payments whenever it is due. Next person is a person who has acquired a right in a building. You know that when they're taking a right in a building lease right they will take. Maybe for 3 years, maybe for 5 years, like that they will get. So here the advantage is that, so 5 years they will get the ownership. So whatever payments and all they will be making, that will be there in the agreement. So for 5 years they will be considered as the deemed owner of that property. Now, different types of rental value you will hear in this problem or in this module. So that is annual value. What is annual value? This is a 2-mark question, sure question. Every time I can see this question. What is an annual value? Rent received or the expected rent a house property can fetch under the given situation, and not only once but from year to year. So here annual value meaning you have to remember. See, when you live in a place, you know that how you can find out how much a rent can. See, if my next building, next flat is given for rent for 60,000 or 75,000. That meaning this flat, if you will give it on rent, then we will get 75,000. So that can be the annual value. So either if it's given on rent, if this property is given on rent, then we are getting 75,000. So that is the annual value. Or we are living in this apartment, but the adjacent flat is let out for rent for 75,000. So our flat also, if it's same size, same facilities, so say we can fetch 75,000. So that will be the annual value. So this word is important, annual value. Now types of rental values, different types of rental values also you will see in this module. One is actual rent. What is actual rent? That is the actual rent paid by the tenant. So when you are giving a house property on rent, some rent the tenant will be paying either 20,000 or 25,000 or 30,000. That will be there in the problem. Now real rental value. What is real rental value? That is, see, sometimes, see, in this building itself, that one flat is given for rent. He is living in, the owner is living in Dubai. So that if now you know that if you are living in an apartment, you have to pay the maintenance charges. Sometimes if you give the responsibility to maintain of paying maintenance charges to the tenant, they may not pay that on time. So it will be problem with the building association and the tenants. So to avoid that, what some owners will do, they will collect rent plus maintenance. See, for example, 75,000 is the rent for the flat. 5,000 is the monthly maintenance. So the owner will collect 80,000. But what is the real rental value? 80,000 minus 5,000, 75,000. So that is you have to remember. Some problems, real rental value, they will say that it's the composite rent. But 4,000 or 3,000 was the maintenance charges. So from that composite rent, you have to reduce the maintenance charges. Because we are calculating only the rental value. We are not concerned about the maintenance charges. This is only an arrangement between the owner and the tenant. Next is municipal rental value. That is valuation decided by the municipality. You have to remember that most of the cases, municipality will fix some value for that. Municipality will fix some value, each locality. It will be different. If it's in a city area, value will be more. If it's in a rural area, value will be less. So they have their own calculations and they will decide one rate for the apartment or the house. Now fair rental value, that is the rent prevailing for similar type of accommodation in the locality. So if you cannot go to the income tax department and claim that, see, your similar apartment is going for a rent of 30,000. You cannot say that I have given it to my tenant at 10,000. They will not believe that. If a similar accommodation is getting 30,000, income tax department will assume that your accommodation also can be given for 30,000. So that is the similar rent your building can fetch from by giving it on rent. Now standard rent is, this is the rent fixed by the Rent Control Act. Actually Income Tax Department, Income Tax Act, we are not concerned much about the Rent Control Act. 1990s and all, it was very popular, but now we are not following that. We are following the standard rent will be there in the problem. If standard rent is there, you have to remember that this is the value fixed by the Rent Control Act. You know that. See, to avoid this, that landowners, if Rent Control Act is there, landowners cannot charge more than that what is fixed by the Rent Control Act. So that is to control the rent within that area, they have that rate. But income tax department is not giving much importance for this Rent Control Act now. 1990s and all, it was very popular and they were using that, but now it is not there. But the standard rent value will be there in the problem. Now, computation is divided into two. First thing, if you want to calculate income from house property, you have to remember that expected rental value you have to calculate. We are going to do the problems also. I told you this is just the theoretical explanation. See, when I'll explain the problems, I'll tell that this is what I explained. So computation is divided into two. If standard rent has not been fixed and if standard rent has been fixed. I told you standard rent is fixed by the Rent Control Act. So you have to see that whether standard rent is there in the question or not. Now, if standard rent has not been fixed, so your question is, your choice is between municipal rental value, fair rental value, and actual rent received. These three values will be there in the question. This is just a 1 minute work. When you learn this topic, you will understand that this is just a simple mental calculation. Whichever is higher is treated as the expected rental value. Next module I have explained also how this with these values, how you get expected rental value. So just the theory I am telling you. This is if fixed standard rent is not given in the question, but other three values are there. Municipal rental value is there, fair rental value is there, actual rental value. So whichever the higher value will be the expected rental value. That is the first step for computing income from house property. Next is if standard rent is given in the question. So you have to do a minor calculation. That is, first you write municipal rental value, then you write fair rental value. So whichever is higher between these two values you will write. Now that value and compare with the standard rent, whichever is less. So this is the calculation. That is why I have put it in the red ink. So between municipal rental value and fair rental value, whichever is higher value you take. Compare that value with the standard rent. So whichever is less, we will take it as the expected rental value. Now computation of gross annual value. Very, very simple calculation. So step 1 is find out the reasonable expected rent of the property. Expected rental value. I have explained the two methods. When standard rent is given, when standard rent is not given. Now step 2. Find out the rent actually received. So that is annual rent will be there in the question minus unrealized rent. Now what is unrealized rent? See, sometimes tenants will not pay the rent. Now this lockdown period, most of the people lost their job. They got salary cut. They are finding it difficult to pay the rent. So here you have to remember that if unrealized rent is given in the question, that will be there separately. 2 months rent is not paid. That meaning unrealized rent. Here the condition you have to remember that tenant is still staying in that house property, but he is not able to make the payment. It can be any reason. So unrealized rent is tenant is still in the house, but he is not paying the rent. So if that value is there in the question, from the annual rental value, you have to reduce unrealized rent. Now step 3 is compare step 1 value and step 2 value, whichever the higher value we are taking. So we will get step 3 value. Now step 4 value, find out loss due to vacancy if any. Now vacancy allowance, you have to remember that house was vacant. See, unrealized rent and vacancy allowance is different. Unrealized rent meaning tenant is still there in the building or in the house property. He still occupied that house property. Whereas vacancy meaning house is vacant due to some reason. Maybe that owner is not getting a tenant for 3 months or 4 months. That will be mentioned in the question. So that is the vacancy. So vacancy allowance you have to remember. Unrealized rent also you have to remember. Vacancy meaning house is vacant. Nobody has occupied. So it's a loss for the owner. So that we will consider in the valuation. Now step 5 meaning step 3 minus step 4. So that is the gross annual value. So we are calculating. So now we are going to the next step. First step is expected rental value you have to calculate. Second one is gross annual value you have to calculate. Now computation of income from let out house property and the self-occupied house property. These two computations. So gross annual value. So now previous slide I showed you how you calculate gross annual value. Now less municipal taxes. This will be there in the problem. So from gross annual value, when you reduce municipal taxes, you will get net annual value. Now you have to remember deductions are allowed in house property only under section 24. I am going to explain in detail. So one thing is there, standard deduction is there, 30%. So the owner will be claiming so many things I made, this payment, that payment and all. We will not consider. Flat 30%. Whether he has claimed those expenses or not, we will allow that deduction. Remember that it's for the let out house property. Second one is interest on borrowed capital. They may be buying they will be taking loan for buying the land. They will be for constructing the house property. Whatever is there, this value will be there in the question. So when you will reduce from net annual value, these two values, you will get income from let out house property. Next one is income from computation of income from self-occupied house property. These two are different. So when you read the question, you have to read carefully saying that whether it's let out house property. Let out house property meaning giving it on rent. So giving it on rent, whether for residential purpose or commercial purpose. Self-occupied house property meaning owner is living in that house. So there also we are calculating the income because he is saving the rent. So he will calculate the rent what he will get from the self-occupied house property. Now gross annual value, we have learned how to calculate gross annual value through 5 steps. Now less municipal taxes will be there. So gross annual value in the case of self-occupied house property, we have to remember that net annual value itself we are taking it as nil. So here you have to remember gross annual value also nil. Municipal taxes also we will not allow, because net annual value for the self-occupied house property we are taking it as a minus figure, nil. From there we are allowing the deductions. So always income from self-occupied house property will be a minus figure, loss. So that is the advantage. See, this is a good tool to save income tax. See, my salary income, it's a positive figure. So what I will do, this self-occupied house property I will get a loss. So one positive value I will adjust loss from self-occupied house property. So I can reduce my income from salary. So that is how we can save the tax payment. We can reduce the tax liability. This is a very good thing allowed by the income tax department. So two deductions you have to remember. Deductions are allowed for house property under section 24. One is standard deduction. Standard deduction also we are not allowing for self-occupied house property. The reason is net annual value itself is nil. See, other houses, big value we will get as net annual value. Whereas here it is nil. Now, but one thing they will allow, interest on borrowed capital. Now, income from self-occupied house property will be always a minus figure, because minus whatever, see, if interest on borrowed capital, if it's 2 lakhs, so 2 lakhs will be the minus value. So if my salary is 20 lakhs, 20 lakhs minus 2 lakhs, so 18 lakhs, my salary income will reduce to 18 lakhs. This is a good adjustment also for reducing the tax liability. Now deductions, I told you, deductions under section 24, very, very important. They will ask you for 2 marks also. So one thing you have to remember, section 24A, 30% of net annual value is deductible irrespective of any expenditure incurred by the taxpayer. The owner will be claiming that this I incurred, that I incurred and all, but we will not look at that. Flat 30%, whether he has claimed some expenses or not, only for let out house property. We have explained in the slide. So second point is not allowed to self-occupied house property. I told you this 30% is not allowed to self-occupied house property. Now section 24B, interest on borrowed capital is allowed as a deduction if the capital is borrowed for the purpose of purchase. If interest on borrowed capital, it is allowed for self-occupied and let out house property. So if the capital is borrowed for the purpose of purchasing a land, purchasing a house property, constructing a house property, repairing a house property, renewal or reconstruction, anything. So this can be anything. Again, I have explained in the help of a chart also. So important points regarding interest on borrowed capital. So this points, this you don't have to bother, but for the theoretical purpose I have explained that. If the capital is borrowed for the purpose of purchasing a plot of land, interest liability is deductible even if construction is financed out of own funds. So it's not only for building the house property, even if you want to buy a land, then that also is possible to get the interest. Whatever, if you're taking a loan, that interest also can be claimed here. Next point is interest on borrowed capital is deductible on accrual basis. It can be claimed as deduction on yearly basis even if interest is not actually paid during the year. See, salary we have seen that whether it's received or accrued basis they will consider. Whereas here interest is on accrual basis. Even if I have not paid for 2 months due to any reason, but I can claim the full interest for that year. Because it is, I am supposed to make that payment, but I have not paid. So that is on accrual basis you can claim that. Next is deduction is available even if neither the principal nor the interest is a charge on property. Usually when the non-performing assets are increasing, people are making default, they are becoming defaulters in payment. What they will do? See, usually till the loan is repaid, the property will be registered in the name of the bank. But here you have to remember that, see, when even if the bank is not creating a charge for the property, interest will be, still they can claim the principal amount and the interest. So this deduction is allowed. Whether the bank has created a charge on the property, meaning when the loan is, we are still paying the loan, meaning ownership of the building or the property will be in the name of the bank. When you clear the loan, then only they will transfer it to the owner. So even if the bank has not done that arrangement, even if still the banker is considering the person who has taken the loan as the owner, this deduction you can claim. Next is interest on unpaid interest is not deductible. So this is, see, I told you, if my case, if I'll take 2 months, I'm not paying the loan interest, then when I'll pay, then after when few months if I'll pay, they will charge penal interest. So that amount I cannot claim here. So whatever actually I'm supposed to pay, I can claim, but not the penal interest. Next is, no deduction is allowed for any brokerage or commission for arranging the loan. There are certain people when they are not eligible to get the loan. There are some brokers between the managers and the the builders. So they will arrange loan. They will pay some commission. They will get that. They will get the papers cleared. Now it is not possible, but this arrangement was there earlier. So here in this case, what they will do, so if you are paying any brokerage, if you claim that you are claiming that some brokerage or commission is paid for arranging the loan, that deduction is not allowed because it is not legal. Next is, interest on fresh loan to repay the original loan is also allowed as deduction. This rule is applicable even if the first loan was interest-free loan. See, this is the thing. See, sometimes government will revise the rates. Now you know that with the lockdown they are reducing the interest rates. So here you have to remember that sometimes when the housing loan interest is reduced, what some people will do, they will take a fresh loan and they will clear the earlier loan which they are paying at a higher rate. So then you are taking a new loan to clear the earlier loan. So that also you can claim as a, but even if the first loan was, even if on the second rule is, first loan was an interest free loan, then also you can claim this deduction. Now interest on borrowed capital is deductible fully without any maximum ceiling in the case of let out house property. So interest on borrowed capital, they can claim the full exemption. Whereas in the case of self-occupied house property, only up to 2 lakhs can be allowed. So that is why interest on let out house property without any ceiling, any amount they can claim. So that is the advantage. There will not be any income after that. So like that they can reduce the tax liability. So this is a good thing for the taxpayer. Now, whatever we have put in deductions under section 24, I have explained again. Deduction 24 for let out property. Let out or deemed to be let out. That is considered as, if he is claiming that my sister is staying there, but actually it may be let out. That is why deemed to be let out. So that standard deduction 30% they can claim. Then interest on loan taken for the purchase, construction, repairs, renovation, actual amount without any limit. So that is what I explained. Actual amount without any limit they can claim. Now standard deduction for let out house property is 30% of net annual value in all cases, irrespective of the expenses incurred by the owner. I told you, when you will do the problems, you will come to know that. They will claim that we paid this insurance, that insurance, fire insurance, groundwater, all this they will claim. We will not see the whatever they are claiming. Flat 30%, whether he claimed the expenses or not, we will allow that deduction. Now, no standard deduction is allowed in respect of self-occupied house property because net annual value of self-occupied house property is taken as nil. So again and again I am explaining this point because already in the chart I have explained. So again and again to make this point very clear. Standard deduction 30% is not allowed for self-occupied house property, but it is allowed for let out house property. Self-occupied house property, the net annual value, the maximum concession they are giving it to the self-occupied house property. Net annual value is taking as a nil value, zero value. So all the interest what you are paying for housing loan and the principal amount you can claim as a minus figure you will get. So that you can adjust with your any positive income, any salary income, interest income, dividend income, business income, anything, capital gain, anything. So this is the advantage. You can reduce your tax liability. Now self-occupied house property. So I have already explained with the help of slide. Again I am explaining self-occupied house property. Standard deduction under section 24 you cannot claim. That is why I put it again. Section 24 it's nil. Then one point you have to remember, this your date is very very important. 1499 you have to remember. 1499. If loan is taken before 1499, purpose is purchase, construction, repair. Maximum limit is only 30,000. 30,000 only if the loan is taken before 1499. Now we are talking about 2020. So many years, 31 years. So that is, if they taken a very old loan, then the maximum limit is only 30,000. Now what is the condition? Condition is certificate from the lender. Please remember that condition from the lender meaning whenever we have to claim this deduction for interest and principal amount repaid for the housing loan, always the income tax department will ask for the certificate from the banker where you are making the repayment with the signature of the manager. That is the certificate from the lender. Without that, if you're claiming that, it's not valid and it's not approved. So that is the certificate from the lender. So always we will calculate that. After March 31st, we will approach the banker. Now it is very easy. We have to just send them a mail. They will send it. So we will tell them, so this is what we are going to do. And then we want to file the tax returns. So they will give that certificate, which with the signature of the manager, the seal of the bank, everything, then it's a valid document. Now, if the loan is taken on or after 1499, so this date is very, very important, 1499. If the loan is taken after 1499, the reason is purchase, construction. If it is for purchase or construction of the house property, maximum limit is 2 lakhs per annum. Conditions, the building should have been completed within 5 years. The construction should have been completed within 5 years. If it's too late, if some legal complications and all, if they are not going to complete that, they cannot claim that. Next is certificate from the lender. I told you this is the certificate from the banker where you have taken the housing loan. Next point is purpose. See, purchase and construction you are getting 2 lakhs per annum. But if the purpose is for repairs, repairing the house property, sometimes some 10-year-old house property, 20-year-old house property, they may do some major repair. So then that time also they will approach the banker for loan. So 30,000 if they can claim only 30,000. But if it's for purchase or construction, they can claim 2 lakhs. So condition is certificate from the lender, meaning certificate is from the banker. This is what I want to explain with this one module. See, this is a very simple chapter. Now you know that 2-3 adjustments I told you. Some rental values, annual rental value, fair rental value, real rental value, standard rent. Then the important thing is how you calculate expected rental value. Then gross annual value, net annual value. Then let out house property, self-occupied house property. Let out house property, you have to remember that we will allow standard deduction flat 30%. It is not allowed for self-occupied house property. Self-occupied house property, net annual value is nil. Another important thing you have to remember, let out house property, without any ceiling, they can claim interest on borrowed capital. Whereas in the case of self-occupied house property, 2 dates are important. Before 1499, if the loan is taken before 1499, limit is 30,000. But if the loan is taken after 1499, if it's for purchase and construction, he can claim 2 lakhs deduction. But if it's for just for repair, the deduction is limited to 30,000. So this is what you have to learn for theoretical concept. It's a very, very simple syllabus and very simple calculation. You will learn in seconds how to do that. 1 or 2 problems when you will do, you will be thorough with that. So this wishing you all the best to learn a simple chapter, simple module. 2-3 modules I will divide into simple modules and then we will close the chapter. So this is what I am going to do that, and I hope that it's clear to you. And this, when I will do the problems, again this concept will be thorough. You will be thorough with that. This is how I am going to explain that. Thank you for watching and give me a feedback. Thank you.